Now, the Reserve Bank of India has cut its key repo rate by 25 basis points to 5.25% in line with expectations. And this marks the total reduction of 125 basis points since February 2025. Now, the move comes amid record low retail inflation, which fell to just 0.25% in October, and a strong GDP growth of 8.2% in the July to September quarter.
The MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. Consequently, the STF rate under the LAF shall stand adjusted to 5% and the MSF and bank rate to 5.5%. The MPC also decided to continue with the neutral stance.
The six-member Monetary Policy Committee voted unanimously for the cut while maintaining a neutral stance on policy. To support liquidity, the RBI will conduct 1 lakh crore rupees in open market operations and $5 billion in forex swaps this month. A repo rate cut lowers the cost at which banks borrow from the RBI. In the current economic context, this is aimed at boosting growth further without stoking inflation, which remains well below the RBI's 4% target. For everyday consumers, this generally translates into a lower interest rates on home loans, personal loans, and EMIs. Businesses may also benefit from cheaper credit, encouraging investment and expansion. However, the impact on loans depends on how quickly banks pass on the rate cuts to borrowers. RBI Governor Sanjay Mehrotra called the current period a rare Goldilocks phase, with strong growth, low inflation, and robust rural and urban demand. Investment activity is gaining momentum, supported by rising private investment and high capacity utilization. With inflation expected to remain soft and credit availability improving, the rate cut aims to sustain domestic demand and economic expansion. Now, the RBI has projected real GDP growth at 6.8% for 2026, with quarterly growth gradually moderating but remaining healthy into the next fiscal year.